All right, what's up, future CPAs? If you're a BS accountancy student with your eyes on the LEPA, you know accounts receivable is going to be on there. So we are going to break it down, but not like your textbook. We're going to use a simple method that's actually designed to stick in your brain, not just for your next quiz, but all the way to the board exams. Let's get into it.
So think about it for a sec. Every single time a company sells something on credit, it's basically creating an IOU. Now imagine a huge company. How do they manage thousands, maybe even millions of these IOUs without completely losing track of everything? That is the puzzle we're solving today.
Okay, so what is accounts receivable officially? Just think of it like this. It's the money your customers owe you. On the balance sheet, it's an asset because it's cash you expect to get soon, usually within a month or two. Getting a handle on this is literally what keeps a business afloat.
Here's our game plan to make AR just click. First, we're going to learn one core rule that seriously runs everything. Then we'll run some plays: sales, returns, collections. After that, we'll zoom out to see the big picture. And finally, I'll give you a cheat sheet to lock it all in for good.
Look, forget trying to memorize 100 different journal entries from scratch. If you really want to crush any AR problem they throw at you, you just need one powerful framework. We're calling it the Golden Rule.
And this is it, the AR roll forward. You start with what you had, you add the new stuff, you subtract what went away, and you get what you're left with. That's it. Every single transaction we're about to talk about fits right into this simple little formula. If you remember only one thing from this whole explainer, make it this.
Let's break that down. So first, you start with the amount you were owed at the beginning of the month or year. Simple. Then you add all the new sales you made on credit. After that, you subtract everything that lowered the balance. You know, the cash you collected, any stuff customers returned, and maybe some debts you know you'll never get back. And boom, what's left is your ending balance. Easy, right?
Okay, time to put our formula into action. Let's look at the most common addition, which is a credit sale, and a super common deduction, a sales return. You'll see exactly how they move the needle on that AR balance.
All right, here's a classic exam-style scenario. Your company makes a sale, 18,000 pesos, on account. Now those terms, 210 and 30, that just means the customer gets a 2% discount if they pay you within 10 days. If not, no big deal. The full amount is just due in 30 days.
So what's the entry? This is your bread and butter right here. You debit accounts receivable because the amount owed to you just went up, and you credit sales revenue because, hey, you officially made a sale.
And see that? That 18,000 peso sale slots perfectly into our golden rule. It's an addition. Your total AR balance just jumped by 18K. It all connects.
But of course, things happen. Let's say the customer wasn't totally happy and they send back 1,000 pesos worth of the stuff. This is one of our deductions.
So what do? We basically hit undo. We credit accounts receivable to lower what that customer owes us. The debit goes to a special account, sales returns, which is a contra revenue account. Basically, it just tracks how much of your sales are being sent back. Your AR balance just went down.
All right, on to our other key deductions. Let's talk about what happens when we get paid, the best part, and also the not-so-fun part, what we do when we realize some of that money is just never coming. So, let's jump back to our scenario. The customer is smart. They want to pay quickly to get that 2% discount. Now remember, they already returned 1,000 pesos of stuff, so they really only owe 17,000 pesos now.
Okay, check out this entry. It's got 3 moving parts. First, you debit the cash you actually got in your hand. Second, you debit sales discounts for the amount you gave up to get paid early. And this is key. You credit accounts receivable for the full 17,000 pesos. You got to wipe their entire remaining balance off your books. Now for the tough one. You've sent emails, you've made calls, but a customer who owes you 3,000 pesos just isn't going to pay. It's time to write it off. This is another one of our deductions from the AR balance.
Now listen closely, because this is a major pro tip. We don't debit an expense account right now. Instead, we debit an account called allowance for doubtful accounts. Think of this like a piggy bank you've already been saving up for exactly this kind of situation. We just take the money out of that piggy bank to cancel out the 3,000 peso receivable. So, where does that piggy bank come from?
Well, that brings us to a super important concept for your exams and for real life: net realizable value, or NRV. This is all about the difference between what your books say you're owed and what you actually think you can collect.
Think of it like this.
Gross AR is the total wish list of everything customers owe you. But we're accountants, we're realistic, we know some people won't pay. So that allowance account is our best guess of what we won't collect. When you subtract that guess from the total, you get the net realizable value. It's a much more honest number to show investors.
And here's exactly how you'd see it on a real balance sheet. You show the big number, the gross AR, but then right underneath, you subtract the allowance. The number that's left, the net realizable value, is the figure that actually gets added to the company's total assets. It's all about transparency.
Okay, let's bring it all home. Time for a rapid-fire review. These are the non-negotiable, must-know points you need to have down cold before any exam.
Seriously, screenshot this slide. This is your study guide right here. The roll-forward formula is your everything. Know your additions, know your deductions. Remember why sales discounts exist, and please, please, please drill those journal entries for every play until you can do them in your sleep. That's the real hack.
So, you've got the accounting down now. You know how to track AR like a pro. But here's the next level question to think about. How can a business use all this data not just to report what happened, but to actually get their cash faster in the future? That's where accounting stops being about rules and starts becoming business strategy. Keep that in your back pocket. Good luck on your exams. You got this.